Welcome to International Securities Exchange's podcast series. Facilitated by renowned educators, ISE podcasts are intended to teach beginning as well as seasoned investors the ins and outs of trading. To find an updated list of podcasts, please visit www.ise.com/podcasts. Please be sure to listen to our important message following this episode regarding the risks of investing in exchange-traded options.
Welcome, everyone. This is Steve Meizinger, your host, and today I'll be your presenter talking about low-correlated investment strategies. I'm the Director of Education at the International Securities Exchange, and I frequently present, and also, I guess I'm always always the host, but today I'll be presenting, and I also answer my emails at asktheexpert@ise.com if you have any sort of questions regarding foreign currency options. We'd love to hear from you. If you have any questions about options, you could always go to the website the phone number 1-888-OPTIONS or optionseducation.org. Those are some places that you can learn more and more about options. Of course, the ISE, whether they're webinars, podcasts, or now we have timely articles that we have available. So please go to the ISE website, www.ise.com/FX, and you'll be able to see everything that we have there. A little bit about the ISE FX options. They're accessible through your options broker. They're exchange-listed securities. They're cash-settled in U.S. dollars, European-style exercise. They can be traded as spreads. And we have 6 majors. The Australian dollar would be the one that's been, at least recently, the most volatile, and that symbol is AUX. All the pairs are relative, are U.S. dollar relative. So if you're looking at U.S. dollar and what is it really worth relative to another currency, so the U.S. dollar is the base currency, and the symbols are all right there. AUX would be the Australian dollar. British pound would be BPX. Canadian dollar, CBD. Euro would be EUI. Swiss franc would be SFC. The Japanese yen would be YUK. Again, and since the U.S. dollar is the base currency, if you're bullish, you'd be buying calls or something similar. And if you are bearish, you'd be buying puts. Let's talk about financial plans. And it's very important to think about in this market where, again, there's so much uncertainty. Financial plans are so important. So the plans should be tailored to each investors' own financial goals and risk tolerances. So it's really important, when you're building this overall portfolio is, how much time do you have? You're looking out 30 years, you're looking out 30 months. And then you want to think about, timing is very important, short-term, intermediate term, or long-term. And hopefully, though, the time horizons can complement each other. So if you may have long-term goals, you could use short-term goals as more tactical to get you to your intermediate goals and then eventually to your long-term goals. There's a lot of ways to construct portfolios, total holdings of various asset classes such as securities, commercial paper, and we've seen a lot of problems with commercial paper in the last couple of months. Options, foreign currencies, commodities, real estate, of course, that's been sort of another big problem of a financial institution or a private investor. So, many of us are just private investors. But again, we're building portfolios trying to build wealth. That's the whole idea of it. Which assets are right for your portfolio? Well, there are many factors that are involved. Of course, your age. It's going to be your financial needs, your ability to take risk. Risk is huge. Risk and reward must always be considered. So what's your risk? The potential to lose some or all of your investment. And it's really important to think that way because, as we enter into different strategies, we may not think that we could lose our entire investment, but again, it depends on the strategy that we select. You want to consider the potential risk of putting all your investment eggs in one basket. It's really important to think about, well, if you're certain strategies, you're putting a lot of your capital at risk, depending on sort of the strategy or the tactics that you use when you're implementing a certain strategy. What should you be considering? Well, diversification. Really important to think about diversifying in different ways. So we have popular asset classes, equities, bonds, foreign currencies, commodities, real estate. And those are certain asset classes that you can look at. And again, as we look at 2008, most markets are down. I would say just about all the markets are down in the equity markets. Some of the bond markets are up, though. Foreign currencies, and I'm going to get to this later, a lot of foreign currencies, depending on which ones you're looking at, some are down quite a bit, and some are actually up quite a bit. Commodities, most commodities are down. I would think just about all commodities are down. And real estate, most real estate is down quite a bit. So foreign currency as an asset class. What does that mean? Well, you can actually take a portion of your overall portfolio and consider foreign currency as an asset class. Prior to globalization, many investors kept their money in their local equity and bond markets for safety reasons. The new modern portfolio theory states that rational investors should seek undervalued assets with low correlations that will help smooth out investment results. And I'm going to get to correlation in just a brief few moments. But really, for me, the idea of correlation is, will things move in the past? Will they move alike in the future, or will they sort of diverge? And that's really a very important concept. And think of it simply. If you're buying all airline stocks, more than likely all the airline stocks are going to move alike. If you buy oil stocks, well, they're going to move all alike also. But if you were thinking about it in more of in a diversified way, you could actually buy a little of one and a little of the other. And again, foreign currencies could be another way to diversify your portfolio. So let's talk about this portfolio approach. Investors might want to add low correlated instruments to their portfolio to smooth out the results. An investor may want to choose some of their familiar equity option strategies. So just because you're diversifying doesn't mean that you should enter into option strategies that are very, 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 risky, or something that you wouldn't normally enter into. Well, that's why there's nothing wrong with diversifying, but you should fully understand any option strategy that you select, understand the risk reward, and make sure that it's appropriate for you. But many FX option strategies might have low correlation to the equity market. So for many of us, that may be something that we're looking for, to just diversify our overall portfolio. So let me go through why trading non-correlated assets might make sense. Whether you like to trade with a directional bias, which means you like to sort of select the market going up or down, or trade with more volatility bias. Again, that's sort of been the way of the markets recently, very, very volatile. Either way, you can smooth out your trading results. Portfolios need to be actively managed. Of course, if you're looking out, many, many decades, maybe less so, but, you're always going to need to rebalance your portfolios. All this makes sense. So even if you're younger, you're going to want to do some rebalancing, and you're going to probably want to use options in some way, because options give you limited risk. So managing assets that aren't all moving in the same direction is much easier. And that's really the whole point here, the whole focal point of this presentation, is that, if you're, again, getting back to oil stocks versus airline stocks, I'm not recommending one or the other, but again, owning all oil stocks or airline stocks is extremely risky, extremely risky. So that's, it's very important to understand that you don't want to have that kind of risk. So volatility, what is it? Volatility defined tending to fluctuate sharply and regularly. So volatile market conditions. Why is it important to understand? Markets should be rational all the time, at least according to academic theories. In practice, this isn't true. In fact, we've just lived through this in the last couple months. For those of you that have been trading for many years, you've probably seen this before. 1987, 1997, 1998, and again, back into 2000, we saw more irrationality. And this happens from time to time. We really never know when this is going to occur and how long it's going to last. In fact, this irrationality in the market we're in today is lasting much longer than many would expect, but you don't really know.
Thank you for listening to our podcast. To find more podcasts on options, stocks, alternative markets, and market data, please visit www.ise.com/podcasts.